Welcome to The Deep Dive, your go-to for really unpacking the numbers behind the headlines. Today, we're plunging into the recent Q1 FY26 earnings conference call for Polycab India Limited. Our mission: to extract the most impactful insights quickly and clearly, so you're not just informed, but, well, genuinely well-versed in what's driving one of India's manufacturing giants.
That's right. When we first looked at these numbers, they truly popped. Polycab has reported what can only be described as a record-setting quarter. And we're here to understand the intricate how behind that performance and, crucially, what it signals for the broader economic landscape they operate within. It's more than just a good quarter. It's almost a masterclass in strategic execution.
You're going to want to pay close attention because the management didn't just share numbers. They laid out a compelling picture, both their current operational strength and an ambitious strategic vision for the future. So let's get straight into it. When we talk about headline numbers, what were the absolute standout figures from this quarter for Polycab? Did anything, hit a new record?
Oh, they absolutely did, yeah. This quarter wasn't just good, it marked the highest ever revenue and profitability in the company's history. Consolidated revenue, for instance, saw a robust 26% year-on-year growth, primarily powered by their wires and cables business. But here's where it gets really interesting for you: their EBITDA.
Okay, the core profitability measure.
Exactly. Earnings before interest, taxes, depreciation, and amortization, that soared by a jaw-dropping 47% year-on-year.
47%, wow. That's much faster than revenue.
Precisely. Significantly outpacing their revenue growth, which tells you a story of incredible efficiency.
That's more than just growth, that's leverage in action. And that 37% EBITDA surge meant a substantial improvement in their margins, right?
Exactly right. They delivered a 210 basis point improvement in EBITDA margin, pushing it to an impressive 14.5% for the quarter.
14.5, okay.
And on the bottom line, profit after tax, or what's left for shareholders after everything, that was also their highest ever for a first quarter, hitting roughly 600 billion rupees.
600 billion, that's a massive number.
It is a massive 49% year-on-year increase. Their PTA margins also improved significantly by 170 basis points, landing at 10.2%.
So how did they pull off this profitability magic? What were the key ingredients in that recipe? What did management say?
Well, they pointed to a pretty precise combination: strategic pricing actions, enhanced operational efficiency, and a favorable business mix.
Okay, break that down a bit. Strategic pricing.
Yeah, think about it. Strategic pricing isn't just raising prices across the board. It implies targeted adjustments, likely on high-demand products where they have strong market leadership.
Right.
Combine that with streamlining their supply chain, their manufacturing processes. That's the enhanced operational efficiency. And then there's the favorable business mix. So when higher margin products, maybe within FMEG, for example, become a larger part of your sales mix,
it lifts the whole average.
Exactly. It dramatically boosts your overall profitability. It's a clear signal they're managing both their costs and their revenue streams with, exceptional effectiveness.
Those are some truly impressive numbers on the surface. But to really understand Polycab's stellar performance, we need to go beyond the headlines. So what's really happening beneath these impressive figures? Let's dive deeper into both the broader macro forces at play and then zoom in on their individual business segments.
Okay, starting with the global macro environment. The company noted a brief period of heightened volatility. This was due to that escalation of hostilities between Iran and Israel, you remember?
Right, yeah.
It briefly pushed up oil prices, drove a flight to safe havens, all that stuff. However, management was quick to highlight that a rapid ceasefire restored calm. It suggests the impact was more a blip, really, than a significant headwind for them.
Shows how quickly things can shift.
It does. It shows how quickly global events can ripple through markets, even if only temporarily.
That's a good reminder of external factors.
Yeah.
But domestically, here in India, it seems the economic foundation remains incredibly robust. What did Polycab's management point to as key drivers there?
They highlighted several strong tailwinds for India: a favorable inflation trajectory, for one, proactive central bank measures, strong liquidity. These are all contributing to sustained economic expansion.
Okay.
And what's particularly encouraging for a company like Polycab is the gradual improvement in consumption demand. We're seeing this through rising electricity consumption, increasing electronic imports, and robust government revenue expenditure. This creates a really fertile ground for their products.
And it's not just about consumption, is it? We're seeing a broader economic momentum.
Exactly. Service activity is gaining considerable pace. That's evidenced by encouraging trends in the Purchasing Managers Index, the PMI, which is, a key indicator of economic health.
Right.
We're also seeing strong vehicle registrations, good diesel consumption, signaling robust commercial and industrial activity. Even the monsoon progress, interestingly, has been highly favorable, tracking 15% above the long period average.
Which is crucial for rural demand.
Absolutely crucial. For rural demand, agricultural output, which then supports broader economic health. Add to that, digital payments continue to surge, and manufacturing output, along with steel and cement production, is showing resilient growth. These are all signs of an economy, kind of firing on multiple cylinders.
With that kind of robust macro backdrop, you definitely expect strong performance.
Yeah.
But where did Polycab really shine within their own operations? Let's zoom in on the business segments themselves. The wires and cables division truly was the primary growth engine, wasn't it?
It absolutely was, no question. This division delivered a very strong 31% year-on-year revenue growth, and importantly, with over 25% volume growth.
Okay, so real demand, not just price hikes.
Exactly. That kind of volume expansion tells you they're not just raising prices, they're moving a lot more product. Within wires and cables, the domestic business revenue grew by an impressive 32%. Driven by high government spending, improved budget execution on infrastructure projects, and supportive commodity prices, which obviously helped margins. Their international business also grew significantly. It now contributes 5.2% to their consolidated revenue.
That's a decent chunk now.
It is, and it's a key strategic expansion for them. And the unit margins for wires and cables stood at 14.7%, a solid improvement over last year.
Okay, moving to the FMEG, or fast-moving electrical goods segment. This has been a segment they've been working to turn around, and it looks like they're making real progress.
They certainly are. The FMEG segment recorded an 18% year-on-year growth, and this was despite what they called seasonal headwinds from an early monsoon, which can sometimes dampen demand for things like fans.
Right.
What's critical here is that this segment achieved its second consecutive profitable quarter.
That's big for them.
It really is. This isn't just a number, it's a significant milestone in their strategic transformational journey for FM. They're clearly focused on premiumization within FMEG, their premium product portfolio now contributing roughly 25% of their total FMEG base.
A quarter of sales from premium now.
Yeah. And e-commerce is also becoming a larger share of FMEG revenue, which really supports their premium offerings and helps reach a wider customer base.
And I noticed a real standout within FMEG, the solar product category. That seemed quite strong.
It really shone through, didn't it? And yes, that pun was absolutely intended.
Okay.
This category saw more than double its growth over the same quarter last year. It's actually become the single largest contributor within the FMEG portfolio now.
Wow. What's driving that?
It's largely driven by government rooftop solar schemes, like the PM Suryagar initiative, and also state-level incentives in key states. They mentioned Maharashtra, Gujarat, Tamil Nadu specifically.
Got it.
They expect this demand to continue for the midterm, and they're strategically focusing their efforts here on solar inverters, cables, and switches. They're not looking to diversify into other solar product categories like pumps or rooftop installations just yet, keeping it focused.
Now, the EPC segment, that's engineering, procurement, and construction, saw a revenue decline this quarter. What's the story there?
Yeah, while the EPC segment did see revenue decline by 19% year-on-year, it's important not to dwell too much on this short-term dip, I think. They maintained a healthy 7.7% profitability margin, which is pretty solid for construction-type projects.
Okay.
More importantly, they highlighted a strong open order book that offers good visibility for future growth. Specifically, their EPC order book stood at approximately 70 billion rupees at the end of March.
70 billion?
Plus an additional 80 billion rupees for the massive BharatNet project.
Ah, the Rural Broadband Initiative.
Exactly. That's the government initiative to bring high-speed internet to rural India. And another 40 billion rupees for RDS, all executable over the next 3 to 4 years. So good long-term visibility.
And the margins on those projects?
Well, the BharatNet project in particular is expected to yield attractive margins. They guided 14%. And its working capital cycle is favorable because of upfront payments, which is a big win for their cash flow.
Right, cash up front is always good. And on the overall financial health front, how's their balance sheet looking after all this activity?
Very strong, very healthy. They're maintaining a net cash position of 31 billion rupees.
Cash, okay.
Their working capital cycle, which, basically measures how efficiently they manage their short-term assets and liabilities, was 43 days this quarter. While it's expected to normalize slightly, maybe to 55 days, this still indicates very healthy operational efficiency.
Means they get paid quickly.
Pretty much. They're very good at converting their raw materials and receivables into cash quickly. CapEx for the quarter was 4.1 billion rupees. That's right in line with their Project Spring guidance.
Which is their big investment plan.
Right, investing 12 to 16 billion rupees annually through FY30. Primarily focused on wires and cables capacity expansion and backward integration.
So if we pull all of this together, what does Polycab's Q1 FY26 performance and their management's commentary truly mean for you as someone looking to understand the broader market and their strategic direction?
Well, it means several things, I think. First, their long-term Project Green roadmap for the FM business is quite ambitious. They aim for FMG to grow at 1.5 to 2 times the overall industry growth.
1.5 to 2 times. Wow.
Yeah. And they're targeting 8-10% margins by FY30. This suggests they believe the FMEG industry itself will see a significant pickup, largely driven, they think, by the real estate sector.
That makes sense. FMEG ties into housing.
Exactly. And it's key because FMEG typically offers higher margins than basic cables.
On the export side, you mentioned the U.S. remains a critical market for them. It made up roughly 1/3 of their Q1 exports, right?
Yeah.
Well, what's the strategic angle there, especially with all the global trade dynamics?
Yeah, this is a fascinating point. Management highlighted that India currently benefits from a significantly lower tariff situation into the U.S., around 10%, they said. Compare that to competitors like China, facing a hefty 55% tariff, or even Mexico at 30%.
That's a huge advantage.
It's a massive competitive edge. It makes Polycab and potentially other Indian manufacturers a very attractive alternative in global supply chains, especially for U.S. buyers looking to diversify away from China.
And outside the U.S., are they seeing Chinese dumping?
Interestingly, they said they're not seeing significant dumping from Chinese players in markets like Europe or the Middle East. Apparently, customers there are often willing to pay a premium for alternatives to Chinese suppliers.
Okay.
Australia, however, does present more direct price competition. That's because China has a zero tariff treaty there.
So a very nuanced picture globally.
Very nuanced. And it shows they're thinking carefully about these dynamics.
The word slowdown seems to be on everyone's mind when discussing global economies, even India sometimes.
Yeah.
What was Polycab management's take on a potential slowdown in India?
They were very clear on this. Very emphatic, actually. They are not seeing any slowdown. Yeah. In fact, they presented data reinforcing the opposite. Government capital expenditure, for instance, has significantly picked up, spending 1.26 trillion rupees monthly since December. That's nearly double the previous period.
That's a big jump in government spending.
Huge. And combine that with strong residential housing demand, especially evident in Tier 3 to 5 cities, they believe it supports continued robust demand for wires and cables. So their view kind of contradicts some broader narratives you might hear out there. It gives you a specific insight into where Polycab sees the market, at least for their products.
Okay, on margins. While they delivered that impressive 14.7% unit margin in wires and cables this quarter, their long-term EBITDA margin guidance is a bit lower, at 11-13% by FY30. What accounts for that slight difference? Why guide lower long-term?
That's an important distinction to note, yeah. Their 11-13% EBITDA margin guidance is a 5-year outlook, and it wisely accounts for variables. Things like significant capacity expansion costs under Project Spring. Building new factories isn't cheap.
Right, that eats into margins initially.
Exactly. And also increased B2C advertising and promotional spend. They want to build that brand, especially in FMEG. With the upcoming festive season, they anticipate investing heavily in brand building.
Got it. Protecting the future.
Precisely. They also clarified that about 90% of their sales to distributors are hedged against commodity price volatility, which is a smart move to protect those margins day to day. They're definitely playing the long game here.
And looking at their market position, where do they stand in the organized wires and cables market? Are they still gaining ground?
Absolutely. Their market share in the organized wires and cables market was around 26-27% at the end of FY25.
So over a quarter of the organized market.
Yeah. And this represents continuous improvement. It's largely driven by, well, a few things. Their extensive manufacturing capacity, a comprehensive product portfolio, their robust distribution network, and also that ongoing structural shift in India from unorganized players towards organized players like Polycab.
Right. Formalization helps them.
Big time. This consistent gain in market share is a significant competitive advantage.
You mentioned their ongoing capital expenditure for expansion. Are they moving into any brand new product areas or just expanding existing ones mainly?
Currently, it's primarily focused on wires and cables capacity expansion and that backward integration, producing more of their own components to control costs and supply.
Okay.
They did clarify that while they are strong in low and medium voltage cables now, they expect to see meaningful revenue from extra high voltage cables, or EHV cables, only around FY28.
So that's a few years out.
Yeah, it's a longer-term play that's a tender-based business, requires significant plant commissioning first. So it shows you their phased approach to growth. They're not rushing into everything at once.
Right. This is the deep dive. And we always like to push the boundaries of thought a little. So for a bit of fun, and let me stress, definitely not financial advice, let's explore an outrageous but plausible trade idea based on what we've just unpacked about Polycab.
Okay, let's do it. Given their incredibly strong balance sheet, that laser focus on premiumization across segments, and those clear long-term tailwinds from Indian government infrastructure spending and the real estate sector, you could maybe consider a synthetic long position on Polycab.
Okay, synthetic long. And for those less familiar, that's basically building a bullish bet using options, right?
Yeah.
Like buying calls and selling puts.
Exactly. It lets you capitalize on expected upward movement, but with a sort of defined risk profile compared to just buying the stock outright.
Now for the outrageous part, what makes this idea outrageous?
Well, the outrageous part is perhaps betting on a continued re-rating of the stock that isn't fully priced in yet, driven specifically by the market finally recognizing the sheer scale and consistency of their market share gains from the unorganized sector.
So the idea is that the market still underestimates how much share they're taking.
Potentially. The outrageous element here isn't just the current positive sentiment, which is already quite high, but a belief that this market share shift could actually accelerate faster than even bullish expectations, maybe driven by specific subsegments.
Okay, so what's the plausible catalyst that could trigger that acceleration?
The plausible catalyst could be something specific, like a clear, sustained uptick in Tier 3 to 5 city residential construction data over the next, say, 2 quarters.
Digging into that specific geographical segment.
Exactly. If that happens, it could create a powerful positive feedback loop directly into their wires business, particularly maybe their more affordable Adira brand. That could propel their market share even higher than current expectations. The plausible element relies on the macro tailwinds holding strong, obviously, and Polycab maintaining its operational excellence.
So it's about spotting those subtle shifts in underlying demand in those smaller cities that could truly surprise the market.
Precisely. That's the potential edge. It's connecting the dots between macro policy, micro execution, and specific geographic demand trends.
Okay, fascinating thought exercise there. So to recap this deep dive then, Polycab India Limited just delivered a truly record-breaking quarter, driven by robust, high-volume performance in wires and cables, a significant turnaround in profitability in FMEG, led by their absolutely soaring solar products. And all this is underpinned by strong macro support from Indian infrastructure spending and a resilient real estate market.
Yeah, and their strategic focus on premiumization, their intelligent navigation of global tariff dynamics, especially that U.S. advantage, and their disciplined capital allocation. It positions them exceptionally well for sustained growth, even as they strategically absorb new industry capacity for future expansion. It really seems like a company that's firing on all cylinders right now, with a clear long-term vision.
Well, thank you for joining us for this deep dive into Polycab India Limited's Q1 FY26 earnings call. As always, this information is for your consideration and understanding only. It should absolutely not be taken as financial advice. Always do your own due diligence.
And if you found this discussion insightful, we definitely encourage you to keep exploring the information. Consider the broader implications of these trends, not just for Polycab, but for other players in the Indian market too. The lessons from Polycab's quarter, I think, extend beyond just this one company. We appreciate you tuning in.